This is the Financial Freedom Fighters podcast.
What's up, everybody? This is the Financial Freedom Fighters podcast. I am your host, Jacob Sandoval. I am here with my co-host, Mike Magno. How you doing?
I'm good, Jacob. How are you?
I'm good. There's a heat wave in California right now. It was 94 degrees. And I don't know about you, Mike, but I'm not an extreme weather guy. I don't like extreme cold. I don't like extreme hot. I like 65 to 75. I like that 10-degree variance, and that's where I live all day, and that's where I'm happy. So 94, it's a little bit too hot for me. I don't know about you.
Yeah, I'm with you. I don't like the extreme heats. We get obviously all the weathers, right? In northern Ohio here. I know in where you live in the Bay Area, it stays pretty consistent year round, typically, in that zone where you like it. It's tough. I know this week we've had a beautiful end of the summer and the beginning of fall.
Nice. We have another fun topic for you folks. Today, Mike and I are talking about stocks versus real estate. It is an age-old debate within the investment community. And today, Mike and I are going to try to bring a very objective perspective. Obviously, Mike and I are both real estate investors, but prior to being a real estate investor, I was predominantly a stock market investor. And so I have a decent amount of experience there. And Mike also does a little bit of stock investing as well. So we are going to kind of pit these two investment vehicles against each other. And we're going to have a round by round type of debate on the merits and the weaknesses of each investment. And so, Mike, do you have anything to say before we kind of jump into the episode for today?
Yeah, I like this topic today for us to discuss, because I think that's a lot of people who want to get into real estate. That's where they have a lot of their wealth currently, is in the stock market, and they want better returns, right? They want the power of leverage. So there's obviously we're going to debate all the pros and cons to both strategies. But I think it's an interesting topic to talk about on what we're doing, putting out this particular type of content that you and I chose to do. And I think it's a good conversation to have for people. So I'm excited.
Yeah, absolutely. So if we take two steps back, there are a few different types of people with respect to their finances and the relationship that they have to money. There's one set of people who are what I'll call spenders. They spend basically everything that they earn. This is the paycheck to paycheck population. And this is the reality for a lot of Americans. I think the latest stat is 60% of Americans, Mike, live paycheck to paycheck. So there are a lot of people that sit in this bucket. And you're never going to get ahead if you're kind of stuck in that mode of spending everything that you make. So that's one segment. Another segment is what I'll call the savers, Mike, who are doing a little bit better than the spenders, but the extra money that they have, they're just putting it in their bank account or effectively putting it under their mattress, where they're earning basically no interest, 0.01% on their money. And they're never going to get ahead as well, right? Because you touched on it last episode, Mike, but the value of your money is decreasing over time. So there's the spenders and they're the savers. And if you hope to achieve financial freedom, you have to shed these identities, the identity of the spender, the identity of the saver, and you have to shift your mindset to be the mindset of an investor. Somebody who allocates their capital to efficient investment vehicles that are going to earn them a return that is going to allow them to achieve financial freedom. But then the question becomes, what do I invest in? The two investment vehicles that have withstood the test of time are stocks and real estate. Those are the two biggest investment vehicles. So Mike and I are going to jump into which investment vehicles are better. We're going to have a nice fun debate. It's going to be a 7-round fight between stocks and real estate, and each round is going to be based on a different criteria. So Mike, let me run through the criteria really quickly, and then we'll kind of jump right in. The first criteria is appreciation. How much will the value of this asset increase over time? So that's round number 1. Round number 2 is cash flow. How much cash will this investment generate? Cash flow. Round number 3 is level of effort. How much work is this investment going to require on my part, the investor? That's round number 3. Round number 4, volatility. How much is this investment going to move up and down over time? Round number 5 is leverage. Can I borrow money to purchase this asset? Round number 6 is liquidity. How easily can I turn this investment into cash? And last but not least is tax benefits. So that is 7 rounds, and we are going to pick a winner for each round. And we'll kind of assess and regroup at the end to talk about the merits of both. And so let's jump into round number 1, Mike. Let's jump into round number 1. I'm going to kick us off. Round number 1 is appreciation. So stocks are famously known for achieving an average annual return of about 10%. If you put your money in the S&P 500, which is the 500 largest publicly traded companies in the US, if you put it in that index, you would be getting around a 10% return on average over a long period of time. If you look back at any 30-year period in history, that is basically what the return would be, which is a really, really strong return. To kind of put real numbers on that, if 30 years ago from today, you invested $10,000 into the S&P 500. 30 years ago, you put $10,000. Today, that would be worth $165,000 approximately. So you put $10,000 in, it grew at a rate of 10% per year. 30 years later, it is $165,000. Not too shabby of a return. So that is the typical kind of appreciation of the stock market. Now, what about real estate? If we look at the average annual increases nationally, price appreciation of homes, if we look at that same 30-year period, the average appreciation is roughly 4% in that same 30-year period. So less than half of the returns of the stock market. Stocks are the clear winner, right? Hold on. Not so fast. There's a really big assumption that's being made when you make that comparison. You're assuming that you can actually achieve the same returns as the S&P 500 index. That is a massive, massive assumption. Here's an interesting stat. 94% of US fund managers underperform the average returns of the stock market. So, Mike, these are big shot Wall Street guys whose sole job it is to beat the S&P 500. It's their sole job. So they spend all day, every day trying to beat the S&P 500. 94% of them fail. 94% of them fail. So what chance realistically does the mom and pop investor, you, Mike, picking stocks, me, Jacob, just like picking stocks, what chance do we have to actually beat the S&P 500? Pretty slim. And there's also the component of emotional selling. I have made so many bad calls with respect to stocks. I bought it at the height and then I sold it at the crash. And so many investors make that same mistake because it's an emotional game. So the pointed stat here, I heard this on the Money with Katie show, another personal finance podcast, and she said that the average return for the typical investor is actually 5%. So not the 10% of the S&P 500, about 5%, half of that. And so it is much, much closer than it looks if we're just talking straight appreciation. But if we just want to very simplify this, let's say straight appreciation, stocks still edge this out. But it's a lot closer than you think because of the emotional selling component, because of the fact it's really hard to actually achieve the returns of the S&P 500. So it's a lot closer, but I'm calling this one for stocks because this is what they're famously known for, is appreciation. And knowing that stat, actually researching that, has actually forced me to shift my stock investing strategy, Mike. I was a stock picker before. I thought I was real slick, and I thought that I could see things that other fund managers couldn't see. And I just stopped all that. I only invest in index funds now. I've come to grips with it that I'm not good enough. And so I only invest in index funds now because I do want that 10% return because it is very solid. So I'm calling stocks take round one, Mike, but I'll pass it over to you. What are your thoughts on kind of the appreciation component?
Yeah, appreciation obviously is a huge piece of what people are looking for in their portfolios, whether it's in real estate or in the stock market. I think the hardest thing too for the stock market investor is holding on to it for that long. It's much easier to hold on to a piece of real estate for 20 or 30 years than it is for you to hold on to that 100 shares of Apple stock. You know what I mean? So, it makes it much more difficult. And then we'll have people, you have people come to us and say, well, what about forced appreciation in real estate? And I mean, there's other ways to accelerate the appreciation. And then if you look at markets like California versus Ohio, well, obviously you guys have appreciated at a much higher rate over the last 30 years than we have. But then in the reverse, you live in San Francisco Bay Area, your guys' prices are down this year. Ours aren't. So it's tough. But they both, they both are going to offer you appreciation. It's what you do with that appreciation once you get it. And that's where I think, real estate will ultimately, win out in total, I think, through our conversation today. But, there's certainly, if you look at like what NVIDIA is doing this year, right? It's nutty. It's up like 200% this year. So for those people who bought NVIDIA, 18 months ago or 2 years ago when it was at the bottom and have held on long enough, right?
Yeah, absolutely. It is important to kind of weigh all factors, and it's not always that black and white. But we'll say stocks take round one, right? Edges it out, but stocks take round one in appreciation. Stepping into round two, I'll have you kick this round off, Mike, but it is cash flow.
Yeah, so cash flow, for the real estate investor, how do we define cash flow? So, cash flow is obviously the money that you get at the end of the month above and beyond all your expenses. And then I also categorize in some reserves as well, which is actually still cash flow, even more cash flow. But, for the investor, they want to set aside some money for expenses that you're going to ultimately, you will have, right? So, in terms of the different types of areas to invest in real estate, people come to like my area for that cash flow. And you may, at the end of the day, get $200 or $300 per month, $400 per month in cash flow. And that money is after principal, interest, taxes, insurance, your property management expense, and then whatever reserves that you set aside. Personally, I just set aside 10%. That's just my own personal thing. So you've got that. And while some cash flow does exist in the stock market, it's only in the stocks that offer you some type of dividend. And the yields on those stocks are much lower in terms of percentage basis. Realty income, right? Like people love that stock. I actually own some. It has a huge dividend yield of, 4%. And they pay a monthly dividend, which is cool. But unless you own $1 million of that stock, you're not getting a ton of cash flow from it. So that's where I think, the cash flow would certainly go into the real estate side of the ledger.
Absolutely. So completely agree there. While appreciation is a major component of building long-term wealth, ultimately cash flow is what pays the bills. Cash flow is what allows you to escape the rat race. It's what allows you to achieve financial freedom because you can't pay the bills with appreciation, right? You alluded to this earlier, Mike, but you have to do something with that appreciation eventually to achieve that financial freedom. So cash flow is king in the financial freedom world. And hands down, real estate is a much, much better cash flow vehicle. So I'll just throw in some specific numbers here to add color to the point that you were making, Mike. So let's take that same S&P 500 investment vehicle, right? And let's say we had 100 grand. We have 100 grand to dump into something. And let's say for the savvy stock market investor, they're not trying to beat the market because they know that they can't. And so they put it all into the S&P 500. The dividend yield that Mike was talking about for the S&P 500 is 1.6%. 1.6%. So on an investment of $100,000, you will have annual cash flow of about $1,600, right? So a little over $100 a month for a $100,000 investment. To Mike's point, that's not a lot of cash flow. That's not a lot of cash flow. You can't even pay for Barry's boot camp on a monthly basis with that. And so, not a good cash flow vehicle, the S&P 500. Let's take that same $100,000 and let's say that we're going to buy a property in Cleveland, Ohio. I think people will be pretty shocked, Mike, but you can buy a 3-bed, 2-bath house cash in a decent working class neighborhood for $100,000. You can. Keep me honest here, Mike. Yeah. Can you do that?
It's certainly possible, right?
Yeah.
I could pull up the MLS right now. I could find us probably 4 or 5 properties in and around the neighborhood where I invest. We could find a property somewhere in the $100,000 range that I could go out tomorrow and put a tenant in there for $1,100.
So let's run that scenario. Let's be conservative even, Mike. Let's say you hook up with Mike Magno and you say, Mike, I have $100,000. I want to buy a property cash in a decent neighborhood, 3-bed, 1.5 bath or 2-bath. And I want to buy it in cash. Let's run the numbers on that. So Mike is going to obviously find you something that is going to fit the 1% rule. And the 1% rule says that the house has to rent for at least 1% of the cost of the property. So for a $100,000 house, it needs to at least rent for $1,000. That's the type of property that Mike is going to suggest to you. It probably, like he said, will be a little bit more, $1,100, $1,200. But let's be conservative, say we can do it for $1,000. So that's $12,000 in annual income, which is great, but we're not factoring in our expenses. Just to do some quick math, let's say that our expense ratio is 50%, Mike, right? 50%, which is pretty typical, I would say, pretty typical. So now we're down to $6,000 in annual income. And because we bought this property in cash, Mike, we don't have any debt service. Right? So now we're doing $6,000 a year on $100,000. So that is the cash on cash return. That is effectively the yield. That's the dividend yield for this property is 6%, right? And this is an average deal that we're finding. We bought it in cash. So that is what we're talking about. That's $500 a month on that same $100,000 investment. And you can do better than that. A 6% cash on cash return, a 6% yield is good, especially in this market, but it is not out of this world a home run deal by any stretch of the imagination. And so to compare that to the stock market cash flow that you're going to see, there's no competition here. There's no competition. And Mike did allude to this, right? There are sophisticated dividend investors and there are dividend strategies. But when it comes to your average investment, real estate in the cash flow realm is always going to beat the stock market. And that is why real estate is kind of regarded as the path to financial freedom, because eventually you're going to need to turn whatever wealth you have into cash flow to leave the rat race. And real estate is the most time-tested vehicle to be able to achieve that. So I think round 2 easily goes to real estate. So we are at 1-1. Stocks took round 1, real estate took round 2. I will jump us into round 3. And this one is level of effort, Mike. Level of effort. And so what do we mean by level of effort? There's a couple of things that we're talking about here. Is one, how much work is this going to take? How much work is their investment going to require from me, the investor, to research it, to acquire it, to manage it, and to, do all the things. So that's one element of it, how much work. And then the second element of it is, what is the barrier to entry? How much is exactly actually going to take to get into this investment? So there's two kind of elements to this. And I think this one is pretty straightforward in my opinion, but we were talking about this, Mike, but you can open up your Robinhood app, click a couple of buttons, and you're a bona fide stock market investor, right? You're a bona fide stock market investor. And just because you bought that NVIDIA stock, or just because you bought that Apple stock, Tim Cook, the CEO of Apple, is not going to call you up and ask you to make a couple of decisions on what Apple's supposed to be doing for their Q4 plans, right? They're not gonna ask you that. There's no work required, and you can be a part owner in Apple for as little as $1, probably even less, right? With fractional investing right now, so barrier to entry for stocks is super low. Literally requires no work. You might do some research, and you probably have to manage your emotions with the stock market, but no one's going to be expecting you to do anything once you become an owner of that stock. And I'll pass it over to you, Mike, but that's not quite the case with real estate.
Yeah, no, you make some really great points there with regards to how easy it is to literally buy stocks nowadays, right? You can just open your app, deposit some money, and boom, you're a stock market investor. Real estate, not the same way. And why is that? Well, typically it's much more expensive, right? We just talked about $100,000 property, which, in today's world, when the average home price in America is over $400,000, $100,000 property seems like a steal, but still $100,000. So, for those people who don't have $100,000, they're going to have to leverage the purchase, and leveraging that purchase means going to a lender and borrowing almost all of the money, right? You're going to borrow on a single family home, non-owner occupied investment property. You're going to borrow 80%. And then how does the bank underwrite you, right? So they're going to check your credit. They're going to check your bank statements. They're going to check your income. They're going to check your tax returns. They're going to look at all these different aspects of you because they're investing in you as well. So it's very, very difficult, right? Then on top of that, you have to find a target market, right? For you, Jacob, you're in San Francisco right now, and I'm sitting in, suburban Ohio, right? Suburbia. Yep. And for you to invest here, you have to find people that you know, like, and trust. Obviously, you and I have become friends, and we've invested together. But that didn't just happen overnight, right? So for that person who's going to invest in real estate, unless you're investing in your local market where you can actually physically go see and touch these things, you have to rely on that trusted network of people. So that takes some time and energy, right? And then on top of it, we talked about it in the last episode, right? The whole inventory, just where the market is today. It's very difficult to find properties that are going to meet all this criteria that we've laid out. It's time consuming, right? Like, you have to search for deals. Your agent has to search for deals. You have to talk about the deals. You have to look at all the numbers of the deal. Does it make sense? It's a much more strenuous process than opening up your cell phone and click. Okay, cool. I bought some stocks.
And you didn't even touch on, Mike, the property management aspect of it. And even if you get a property manager, it's very important to know that you're still going to need to manage the manager. You're still also going to need to make a ton of decisions. One of the tenants in my triplex is consistently late. She pays late fees every single month. And I'm like, what is going on with this? I get a message from my property manager, says, hey, this person is on Social Security. They only get one paycheck per month, and it happens on the 15th. So they're consistently late because they just don't have enough money on the 1st to be able to make that payment because their paycheck comes on the 15th. Can you allow her to move her due date to be closer to her payment date? And obviously I said yes, knowing the details of this, but this is just an example of some of the kind of inquiries you're going to get for your property manager. And sometimes there's going to be bigger things. And so just to say, oh, I have a property manager, I don't have to do anything. There'll be days, there'll be entire months where I don't talk to my property manager at all. And that's not abnormal. But then there's going to be weeks where you talk to them every other day, just depending on what's going on with the property. And that's just something, you have to know that there is work involved, even when you do have a property manager. So I'm sure you have stuff to say on that too, Mike.
Yeah. I mean, we've talked about it on previous episodes, property management. I've said it time and time again. I'll say it till, I don't do this anymore. It's the most difficult piece of this puzzle. I personally right now, I manage my own properties, and I'm going to do that for now. And it saves me some money. I don't have a huge portfolio, but eventually I'll probably get away from that, and I'll be working with a property manager and experiencing those same things that you experience. I'm dealing with it. Today. One of our tenants is late with the rent. So, it happens. It's not the best thing in the world, but we'll work through it.
Yep. So to kind of round this out, and I'll say one more point because I think it's important. We are talking about rental property investing versus the stock market. There are investment vehicles within real estate that can be as passive as the stock market for sure. I'll throw out a couple. Real estate syndications. You can invest in these private syndications where the syndicators, a group of people, are raising a bunch of money and you're taking down a big deal together, right? And you're a limited partner, an LP in this deal. So that's an example. You can invest in REITs, right? Real estate investment trust. And that actually transacts exactly like a stock. And then there's crowdfunding, right? Before I actually jumped into real estate investing, I looked into things like Fundrise and things like that. There are options to be exposed to real estate that are more passive. But what Mike and I are talking about, which is what we do, is active investing in real estate. You are actually the owner of that property and you are operating that property. So just want to clarify that point. And when we're talking about active real estate versus stock market, the clear winner in this case is stocks. So stocks take round 3 quite handily. So we are 2 rounds to stocks, 1 round to real estate, and we are going to round 4, which is volatility. Mike, I will pass it over to you. Talk about volatility for me with respect to stocks and real estate.
Yeah, so volatility is obviously something that a lot of people want to try to avoid. Like you said, you had some in your own portfolio where you got scared and sold off, and we've all done it, right? We've all done it. So yeah, so the volatility piece is obviously anytime you're investing, you have a chance to lose money. That's why it's called an investment. So that's the biggest thing that we need people to understand is, yeah, you're investing your money, and it may turn negative. It's possible. But if you stick with the strategies and you continue to educate yourself, you can mitigate a lot of that risk. So volatility, stock market volatility, it really depends too how involved you are, I think. I don't look at the stocks every day. Like, I just don't. If you look at it every single day, oh my gosh, did you see the Dow today? The Dow was down 2%. Okay, cool. And it'll be up 2% tomorrow. And, so there's that volatility. So in the stock market, to me, you got to get through the noise. There's a lot of noise. The political environment affects it. The Fed affects it.
Yeah. So my perspective here is to kind of define what we're talking about here. Volatility is just the degree of variation in an investment's price over time. How much does this bounce up and down? And Mike touched on this, but so much can move the stock market. So much. Market sentiment, politics, the weather, what Elon tweets, a bunch of different stuff, right? A bunch of different stuff can affect what actually moves the stock market, which makes it basically impossible to predict short term what's going to happen with the stock market, because there's so many variables. And so there's a lot of volatility in the stock market, just a lot, because of all the stuff that can swing it. And to speak on another point, we said it's so easy, right? And stocks actually won this round. It's so easy to transact stocks. You can just pull up your phone, and that's good in one sense, but it's also bad in another sense, because that accessibility makes it so easy for there to be swings in the market, because people can buy and sell at will. And one thing we know about ourselves as human beings is we're emotional creatures. We buy and sell. We don't make rational decisions all the time. And so there's a lot of transacting at a high volume, and there's a lot that can shift the market. So stocks are really, really volatile. On the flip side of that, we said, again, it's not easy to buy a house. It's not actually easy to sell a house either, right? Mike, you've been on both sides of many transactions. It's a journey to do that. You can't just decide, hey, I want to sell, and you can just do it instantly. You can't do that. There's a process. You need to find the right buyer, or you need to find the right property. You need to do due diligence. We talked about how to buy a rental property last couple of episodes. And so there's a whole journey to buying. And that actually is built-in stability for the price of real estate, because you can't just emotion panic sell your house. You can't really do that. You have to go through so much work to do it. So there's a safety net there. There's a safeguard there. And you said this, Mike, it's easy to hold on to a property for a long time because there's just so much work in listing it. And that actually is a good thing in this case, right? This is a good thing in this case. So if we look at it from that lens, I think it's very clear that real estate is the winner of this round. And depending on which stage of your financial freedom journey you're in, volatility might be really, really important to you. If you are a retiree or nearing retirement, you do not want to mess around with volatility. Let's just think about an instance where, all your money was in the stock market and the stock market takes a huge, huge hit. All of a sudden, a huge portion of your kind of nest egg is gone. And so depending on where you're at in your career, in your financial freedom journey, volatility might be really, really important. And in this case, 2008 notwithstanding, real estate is the more stable investment. So I think clear winner, in my opinion, real estate takes round 4. We are now tied 2-2. Stocks 2, real estate 2. Moving into round number 5. Mike, I'll pass it to you. Round number 5 is leverage.
Leverage is a very important piece of the real estate investing puzzle. The ability to be able to borrow against that asset and buy it. You can buy a $100,000 property with $20,000. And that's a very, very powerful tool for people to be able to leverage because it gives you the ability to spread out and scale better, scale more, let's say. You can buy $100,000 worth of stock. You can take that same 100,000 and potentially buy like $1 million property, like where you live, with 10% down as a primary residence. And the returns you're going to see they're going to be completely different because of the leverage piece, right? Because your appreciation is continuing on $1 million, not $100,000. So that's why the appreciation can be very, very powerful.
If you bought a $100,000 property, you put 20% down, right? So you're at $20K. That property appreciates 10%. So that's $10,000. But that's a 50% return on your investment, right? Because you only put 20,000 down. So leverage amplifies returns, as Mike was talking about, where in the stock market, you're only getting 10% on what you invested. So leverage amplifies returns. But important to note, leverage also amplifies losses as well.
Yeah, that becomes people's risk tolerance, right? How averse are they to risk? Because obviously, if you have vacancy, you still have a mortgage to pay. And that's where, people will come at us like, oh, it's debt, it's bad. Yeah, it can be, but done properly. And I'm not saying that you should over leverage yourself, right? You need to take out loans on that you can actually afford to pay, right? Because eventually you will have vacancy. So that's the other piece of it. Yeah, you can also get yourself into trouble, right? So that's where you have to just be careful and not take on more than you can handle as the investor.
Absolutely. Absolutely. And so I'll kind of round us out on this specific piece with respect to leverage, but you can leverage in stocks. It's called margin trading. So some brokerage accounts or some brokerages will allow you to borrow money to purchase stocks. It is very, very risky, very, very advanced. And you should just have caution when you're doing that because in the aforementioned round, stocks are very, very volatile. So if you borrow money to trade stocks and the stock takes a big nosedive, they're going to call that margin loan due real quick. And so you're putting yourself in a bind if you're trading on margin because of the volatility. On the flip side, a bank all day, every day, if you are a qualified borrower, they're going to put 80% up, 75% up to allow you to buy that property all day, every day. That's commonplace. And we have to take a step back and ask ourselves, why is that the case? Why would a bank, willingly give me 80% of the purchase price of the property and I only have to put 20%? Well, one, obviously, the bank makes a ton of money, right? You're paying interest on that. And if you actually run the math, or if you look at an amortization schedule, the bank is getting a ton of money back and they're getting a lot of it upfront because interest is front loaded. So they make sure they get that return for themselves. And then it switches more to principal pay down. But that aside, even if you, for example, foreclose on the property, you can't make those payments, the bank is still pretty confident that because they only put up 80% and they were collecting interest, they're still pretty confident that they can turn around, sell it, and get out relatively unscathed or still make a profit. Now, they don't want to do that, right? Because they're not in the real estate business. but they view real estate as a safe investment. And so that's why they're willing to put up that 80 to 75%, right? So again, another feather in the cap of real estate from that respect. And then lastly, I want to touch on this concept, and you kind of hinted towards it, Mike, but there's a lot of talk about real estate being good debt. And I don't know where you sit, listener, on kind of your relationship with debt. Mike talked about Dave Ramsey, and a lot of people are very anti-debt. And I think that's a fair philosophy to have for a lot of people, for sure. But in the real estate investing space, real estate is referred to as good debt. And why is it good debt? Well, for me, I think real estate is good debt because it is backed by a cash flowing asset that the income generated by the property is enough to cover the debt service. To me, that's what good debt means, is that the asset is paying for itself. Now you have vacancies and things like that, et cetera, et cetera. But in general, it's going to pay for itself. To me, that's good debt. And when you trade on margin for stocks, you're not getting that. You're 100% banking on the appreciation of the property to eventually be able to kind of pay that margin loan back. So you're very much just dependent on the appreciation, which is more akin to gambling, in my opinion. But if you know that this property is going to cover the debt service, to me, that is a healthy amount of risk to take, because that is, a much more stable proposition to put a tenant in there, to have a cash flow, to pay the debt down. And, I feel okay with that. I sleep fine at night knowing that that's the debt that I have. All that to say, round 5, leverage goes to real estate, right? So we are 5 rounds through, and I believe stocks took round 1, real estate took round 2, stocks took round 3, real estate took round 4 and 5. So we are 3 rounds to 2. Real estate is edging out stocks right now. We are moving to round 6, and I think that this one is a pretty straightforward one, Mike. It is liquidity. Liquidity, Mike. So let's talk liquidity. Not much to talk here, but what are your thoughts on liquidity for this round?
Yeah, I mean, liquidity obviously is for those who, maybe new to this and they're learning, liquidity means how quick can we convert that asset to cash. It's pretty easy for me to go sell that stock I just bought on my app, right? I open my phone, I go in there, I hit a sell. It tells me the price it's going to sell it for me, the boom, done. And that money's back into my account as cash. And then I can transfer it out and I'm done, right? I could sell everything in my Robinhood account when the markets open on Monday, and I could have cash in my bank account by the end of the week. That's pretty quick, right? Whereas, houses, that's a little bit tougher. There's a process that has to go to sell a property, right? Got to enter into a purchase agreement. You have to have an agreed upon price and contract. You have to do title work. That takes time. I think everyone would agree that the stocks are pretty easily liquid versus real estate. I mean, it is easier with technology in today's world. It is more liquid than it used to be. But I still, as a real estate guy, I would still lean that the stock market is more liquid.
Yeah, absolutely. I think this one is pretty straightforward, but we'll talk a little bit more about why this is important. Why is liquidity important? For me, what it comes down to is flexibility. If you have a good amount of liquidity, you are more positioned to, one, capitalize on opportunities that might present itself. Let's say a smoking hot deal comes onto the market, right? Mike, you send me a deal, 12% cash on cash return, off market. We need to act fast. If I don't have any liquidity, I can't act on that. I can't take that deal down. And I got to be, Mike, I'm sorry, I'm not liquid right now. I got to pass on it. My wife actually jokes with me all the time because I don't like to have a lot of liquidity in terms of cash. I don't like to hold a lot of cash. For me, cash feels like it's burning a hole in my pocket. And unless I'm saving up for a down payment, I don't like to hold a lot of cash. So I always am either putting it into a deal or I'm just putting it into the stock market. So pure liquid cash, I don't have a lot of it. My wife always jokes with me and she's like, I'm going to buy you a shirt that says, I'm not broke, I'm illiquid. That's her running joke. And I always get a good kick out of it. But anyway, liquidity is good because that's flexibility. So one, you can take advantage of opportunities that present itself. But two, you can also get yourself out of a bind. what if something happens and you actually need to come up with liquidity? Like you have an emergency medical expense, for example, or you have something that, you need to help your family with. You need to have that liquidity to be able to do that. But all that to say is liquidity is flexibility, both in emergency situations, but also to capitalize on opportunities. Stocks offer you much more liquidity than real estate. And that is, I think, round 6 for stocks. And so, Mike, we are approaching the 7th and final round. And we have had a pretty even battle here between stocks and real estate. We are tied 3 rounds to 3. So this 7th round is going to be the deciding round. And the round is tax benefits. Tax benefits. And disclaimer here, quick disclaimer, Mike and I neither of us are CPAs. I have my degree in accounting actually, but I did not take the CPA exam. And so we are not tax professionals. This is not tax advice. So take all of this with a grain of salt and talk to your tax professional. But Mike, round 7, tax benefits. Let's talk about it.
This is one of the things that I think gets passed over the most to the new investor, because all the new investors hear about is cash flow and cash on cash return and ROI and IRR and reserves and everything, right? The tax benefits of real estate, if anyone hasn't been paying attention, the way that the tax code is written in this country, it's to the real estate investor / business owner, period. Like this is literally the knockout punch. This is Mike Tyson, knocking out whoever, right? The tax benefits are unparalleled. And, once again, we aren't professionals, so we're going to leave that up to your professional CPAs to help you with. But I mean, between a depreciation, bonus depreciation, segregation studies, I mean, there's just a million ways to offset income, but still get cash flow. Remember, that's the kicker, right? You get cash flow and then you have paper losses. So you end up not paying any taxes potentially on those on that cash flow. So for those people out there who aren't in real estate yet, that's probably one of the most powerful tools of real estate investing are the tax benefits.
Yeah. So like Mike said, this is definitely the knockout punch for real estate if we're talking about real estate versus stocks. So to just touch on stocks really quickly, there are not a lot of tax benefits when it comes to stocks. In most cases, you are going to be subject to capital gains tax when you sell a stock. If you hold a stock for less than a year, that capital gains tax is going to be a lot higher. For example, I was fortunate enough to buy AMC at a very, very low price before the kind of Reddit craze, Wall Street bets craze, and that jumped up a ton. And obviously I was elated at that because I bought a ton of shares at $2 and it jumped up to like 30 or 25. And so I dumped it, obviously. And that next year I had a pretty big tax bill because I sold it after only holding it for a couple of months. And so that is, I paid 50% taxes on that. So that hurt, but obviously it is what it is. That's how the tax code is written. Now, to put things in perspective, Mike alluded to this, but I always find that this is the part of real estate investing that for the beginning investors actually pretty hard to understand or pretty hard to wrap your head around. Like they think it's a scam or they think it's a loophole, but those are all the wrong ways to think about it because as you alluded to, Mike, this is the way the tax code is written. This is the letter of the law with respect to the IRS and the tax code. So this is not illegal. This is not loopholes. This is just how it's written. This is how the law is written. And so to make it tangible, and again, we are not tax professionals, but to illuminate, right? Let's say that you have built up your real estate portfolio. You've been at the grind. You've been acquiring rental properties. You've held them for a long time. And you get to this place where you finally have that portfolio that's generating $10,000 a month in passive income, that entire portfolio. So you're doing $120,000 a year. You could be in a position that you are paying very minimal tax on that $120,000 a year. Is that fair to say, Mike, that you can be generating that much income, a 6-figure income, right? Which is a lot of money for people. You can be generating a 6-figure income and you will be paying pretty minimal taxes. Now you juxtapose that with somebody who's making a 6-figure active income salary, who's going to be paying a lot more in taxes to the government with that active income. And so just to put a more of a point on it, this is why when the wealthy say they do not pay taxes, it's probably because of businesses and it's probably because of real estate. And they are taking advantage of the tax code. So all of us, right? We shouldn't get mad about that. We have to understand the game that's being played. And over time, we have to allocate the wealth that we're relying upon to be more tax advantaged over time, right? It's just a smart thing to do. We should be shifting the income that we rely upon from active to real estate because there's inherent tax advantages, and the tax advantages are going to allow us to what? To invest more, Mike, and to generate more return, which is going to generate more tax advantage. And so all this to say is that you have to understand the tax code and you have to really take advantage of it, not take advantage of it, but understand it and implement it and follow it to really amplify your wealth building journey. And in this case, there is no comparison. Real estate is hands down the most tax advantage investment class and definitely more tax advantage than stocks. And so this one is a knockout punch, Mike, like you said.
Yeah, the biggest thing I try to explain to people is just, understanding that there are just so many advantages. The depreciation piece is one that people often, they just kind of can't wrap their heads around, right? And for whatever reason, I still don't know to this day, but the IRS allows you to depreciate your properties or rental properties for 27 and a half years. Don't know how they ever came up with that, but basically you can take 1/27th of the value of the building. You can't depreciate land, okay? And that's literally straight subtract it from the income of your gross income off the property. So, you have a property, let's say the building's worth $270,000. So 1/27th would be $10,000, and you had $10,000 in income. It just kind of wipes itself out, very dumbly putting that together, but
no, exactly. And so you can get to a place, ladies and gentlemen, where you're making 10,000 real dollars in profit and you are just completely wiping it out with $10,000 of a paper loss, right? Because your building is not losing value. It's not losing value. That's the misconception and misnomer of depreciation here. It's not losing any value. It's just one of the benefits of real estate. And there are more advanced things you can do to kind of really stack the depreciation and pull a lot of that depreciation forward, but we won't get into that. Another thing that's kind of specific to real estate, Mike, and you're well versed in this, is the 1031 exchange. I don't know if you want to talk about the 1031 exchange.
Yeah, absolutely. We can talk on it for a couple minutes here. The 1031 tax deferred exchange is what it's called. And it's very romanticized out there in the world of real estate investing. And a lot of people don't understand what it is, but it's a way for the real estate investor to sell a property and then take all the gains and reinvest it into a different asset in real estate and just continue stacking properties. And that's how the wealthiest of the wealthy in this country have been executing it for a long time.
Yeah, absolutely. And I have not executed a 1031 exchange, but I'm sure I will use that tool in the toolbox at some point. And luckily I have you, Mike, to kind of walk me through that process with the experience that you have. But for the beginning investor listening out there, I read an earlier book, and I think it was Rich Dad, Poor Dad, but Robert Kiyosaki in that book, he talks about how he turned one single family house, and through a series of 1031 exchanges, that single family house turned into a large apartment building, basically, is the example that he used, because he continuously rolled the proceeds of the sale to be the down payment, like you were saying, Mike, for a larger property. And he just kept on doing that. So eventually the proceeds rolled into this large apartment building that Robert Kiyosaki then owned. And it was directly attributed to owning that small single family property, which is mind blowing to actually think about, right? And that is just a powerful, powerful concept. So if you're just continuing to reinvest the gains from real estate and continuing to take advantage of the tax advantages like the 1031 exchange, like depreciation, you can capitalize and roll these would-be tax expenses into bigger and bigger deals. But it's important to note as well, Mike, you are deferring the taxes. You are kicking the tax liability down the road. But even then, still, really wealthy people figure out a way to get out of that as well. And they pass down that to their heirs. And when their heirs inherit it, they inherit it at a stepped up cost basis. And then that liability is effectively wiped out because they're inheriting it at that new basis. And again, not a CPA. Talk to your CPA before kind of executing on this. But all this to say, there's just such strong tax strengths when it comes to real estate. That's why I think the tax benefits piece definitely is, like we said, Mike, the kind of knockout blow with respect to real estate when being compared to stocks. So I'm going to bring us home, Mike, to kind of wrap up the episode. We compared stocks versus real estate. We had a spirited debate. We try to maintain objectivity when comparing these two kind of investment classes. And where we got to is stocks won the appreciation round, the level of effort round, and the liquidity round. So if those three aspects of an investment are really important to you, stocks shine in those particular aspects: appreciation, level of effort, and liquidity. Real estate, however, won the cash flow round, the volatility round, the leverage round, and the tax benefits round. 4 rounds to 3. So if those particular aspects of investment are meaningful to you, then real estate shines in those aspects. But what Mike and I want to kind of emphasize here is that there is no best investment, right? There's just the investment that is right for you in your personal situation. So you have to listen to this episode and you have to take all this information and you have to apply it to your personal situation. Where are you in your financial freedom journey? Where are you with your risk tolerance? What attributes of an investment are the most important to you? Do you want to prioritize cash flow and low volatility, or do you want to prioritize rapid appreciation and do you want to be as passive as possible? You have to critically ask yourselves these questions as an investor, not just as a real estate investor, but a stock market investor, as an investor as a whole, because these critical questions are going to allow you to devise the strategies that are going to propel you towards financial freedom. And I'll be upfront, right? The majority of my career before investing in real estate, I was dumping a lot of money into the stock market. And today, the allocation of my wealth is about 70% stocks and 30% real estate. But me consistently asking myself the question of where do I want to be and what are my goals? I know that I want to retire in less than 10 years. And now I look at my portfolio and I say, oh, I need to index more heavily into cash flowing assets because that's going to allow me in 10 years to step away from my job if I want to. So now my strategy is more heavy real estate. And I want to get to an asset allocation that's closer to 50-50 in stocks and real estate. So I'm kind of diversifying in that way. But that's a part of me evolving and adapting my strategy, continuously asking the questions and having a goal and having a North Star. And so just ask those questions of yourself and think critically about what you want. But any kind of closing thoughts, Mike, on this topic?
I think it's important for people to understand, like everyone's at different points in their journeys, and it's important for them to really figure out what the goal is. And like you put it very succinctly, right? Like you have a goal. It's 10 years. I want to work optional life, right? So you have to really look at, well, how am I going to achieve
how am I going to be able to achieve the kind of cash flow I need to make that happen in the next 10 years? And really, I mean, it's going to be heavily real estate, because you just don't get the compounding effects, into those things that we talked about: cash flow, debt pay down, leverage, and the tax benefits, right? So that's where it just really becomes, once again, I don't want to bang on stocks, because once again, I open my phone right now and I have a pretty hefty chunk of change that people would be like, wow, that's a lot of money invested in stocks. And I do. I do that with my extra money that, I want to dabble a little bit, right? Have some other things. But, for the most part, I think we really hammered home what the power of the real estate investing is for people, which is kind of what we were talking about. I mean, but that being said, I mean, it's different for everyone. So
Absolutely. And look, we are huge real estate people, but we both have exposure to the stock market. So there is no rule that says you have to purely be invested in stocks or purely be invested into real estate. You can do both, but just think critically about what makes the most sense for you and your personal situation, and devise a strategy that's going to get you to your goals, plain and simple. And so we hope this episode was helpful. This was fun for me to do personally. I just love thinking about this stuff. I love thinking about the best ways to kind of allocate capital, the best ways to kind of generate a return. And it's all in effort of achieving that financial freedom that we are all pursuing, that we're all going after. And so we hope this episode was helpful for you today. This is the Financial Freedom Fighters podcast. I am Jacob. You can find me on all socials at Cashflow Saga and my website, cashflowsaga.com. You can find Mike at Realtor Michael Magno on all socials. This is episode 5. We will see you guys for episode 6. That's a wrap.
see ya.